What's going on, everybody? Happy Wednesday. It's a beautiful Wednesday. It's time for our Wednesday workshop. Got a great topic, one of my favorite topics, and we're going to get into that in just a moment. Before we get into it, though, I want to bring in our special sponsor for the day. Steve, are you there? You want to pop in?
Hello. Hi. How's everybody doing?
Good. How are you, my friend?
I'm doing well. We got some really nice presentation prepared for everyone today.
Awesome. So just to give people some background, me and Steve have been friends for a long time. He runs a phenomenal company called Real Estate IQ that helps real estate investors find deals. So they are getting their operation up and running, really, targeted in Florida. And since we're based in Florida, it just makes complete sense to get Steve on the program with us so that you guys can use him as a resource. So Steve, take it away. If you've got some slides you want to share, go ahead and do that as well.
Thank you, Nate, and thank you for having me. Thanks for everybody for being here. I got some really cool statistics for you. Real Estate IQ, we are a data company and we focus a lot in finding motivated sellers. So here I want to share some of these U.S. economics data and also the local Florida real estate statistics, and also to share with you some of the deals that we are mining in Florida. So we hope you like it. Let me go on present mode. All right. So what we're looking at here is the inflation rate, month-to-month inflation rate in the United States. As you can see, we're looking at a higher and higher inflation index here. The next slide is the unemployment. We see the employment has been coming down. It has gone from a very high of, I think, about 12% last year, all the way down to under 4.5%. Next, we have the personal consumption. We can kind of see these are kind of indications combined that the U.S. economy is recovering. We're seeing the huge increase and a boost in the consumption spending index. And then last one is our refinance activity. You can see that what we have here is as of the end of July, about 3,570 applications on refinance. So just some indicators for you to kind of understand how our general economy is doing. Next, last week when I was here, or actually it was September 1st, I was sharing with everybody some of the months in inventory numbers for the state of Florida. So we want to continue that here. So this slide, we have both Miami and Tampa. You see the huge median sales price of $515,000, which is a 25% increase comparing to July. We see a number of listings decreasing. The days on market is 17 days and 2.2 months of inventory only. In the Tampa Clearwater area, 338,000 median sales price, which is over 20% increase. The active listings, there's a decrease. We're seeing the inventory and the active listings going down and down. And look at this, 6 days on the market. So this next slide, we have Jacksonville and Orlando. Jacksonville, you see 300K in medium sales price, 31 days on the market, and 1.4 months in months of inventory. And then finally, we have Orlando, an 18% increase in median sales price at 320,000. And also continue a decrease of days on the market. And you see here, the months of inventory, it's not even months, it's weeks. We have 3.5 weeks, which is less than 1 month, probably 0.8, 0.9-ish. So the market is just super hot right now, and we're seeing a big increase in our sales price. Not a lot of properties for sale. Everybody has a lot of savings and moving. We're going to skip these couple of slides. For those of you who are interested in seeing the actual report, go ahead and send me an email. I'll put my email address on the chat after this. So we're more than happy to share with you some of these reports, and we're generating these on a monthly basis, really awesome charts that gives us a really nice glance of how the market is doing. So now we are arriving at the pre-foreclosure trends. We were talking about the amount of inventory on the market right now is decreasing. It's very, very low in the Florida market. And we focus our attention on the lower left side. We are looking at the Florida market for pre-foreclosure filings. And we're seeing that, there's we had a peak of January of this year, and that came down a little bit. And overall, I would say that the pre-foreclosure filings are on a slight trending up. And for the Orlando area, we termed that the Florida Triangle in that area. So that's why you see three charts. The blue one is the Miami Fort Lauderdale. The Tampa one is the yellow line, and the light blue is Florida Triangle. This one is the total amount of motivated sellers. So what we saw earlier was just the pre-foreclosures. These are very motivated sellers, and there are many different types of motivated sellers. So this chart, if you look at the lower left corner again, is we see the total number of motivated sellers that we mine on a monthly basis. And we're looking at, probably a total of, let me very quickly add it up, about 4,000 motivated sellers. So just kind of looking at, remember, the months of inventory going down, but we're kind of seeing the number of leads starting to trend up. So the off-market leads are really going to be your source of these motivated sellers. A couple of conclusions. When you request a report, you'll have it. Now I want to first of all, I want to say, hope you guys enjoy these kind of snippets of how the market is doing. We also want to invite you to our Connect, the second edition. We have a really awesome platform where you can do a lot of cool networking and speed networking, and you can visit different sponsored tables and get to know everybody on this really cool platform that we're using. We had a great success in the last quarter. We want to invite you guys to come. I will post the ticket link here. And as a NuView Trust client, we want to offer you a free ticket to attend. Next, if you would like to schedule a free consultation on understanding the different types of motivated sellers and how to utilize it to get your deals, go ahead and schedule a free consultation. Again, we'll post the link here. And thank you for having us. If you want to learn more, go visit our website or dial this phone number here. And you can also follow us in our social media channel where we're publishing a lot of these reports just right on the spot. And thank you so much for having us, and look forward to meeting you soon.
And thank you, Steve. And guys, please make sure to check out Steve Liang and Real Estate IQ. They can be a great resource to you guys, how to find properties, how to find motivated sellers. And our topic today meshes right well with that. And make sure to attend their event October 2nd. Free tickets, is that what you said, Steve? Free for NewView clients?
Yeah, free tickets.
Okay, so it probably makes sense for any people who are watching the webinar who are not NewView clients to maybe open an account first and then get that free ticket, right? Bam. All right. So check it out. I'll be there as well. So thank you, Steve. We'll talk to you guys soon. All right. So let's get underway. And Steve shared some great information. Some of the things that I was thinking about in that information is obviously the market is, pretty tight. People are rushing out to try to get property, but there's no inventory. How do you get properties in a market like that? Well, this topic may help you do that. And what we're talking about today is how to use private money or private capital to buy real estate or other investments, but how to use it from self-directed IRAs. If you've been paying attention to a lot of our education and our webinars, we talk a lot about how you use your own self-directed IRA and the advantages when it comes to taxation and yada, 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 yada. But very few times do we touch on the other side of it, which is the other side of using other people's IRAs to fund your own deals. If you're a real estate investor, you should be thinking about self-directed IRAs in two fashions. One, since you understand real estate and can make money in real estate, you should understand how to invest in real estate through your own self-directed IRAs. As you understand how to do that, that unlocks the other side of the equation, which is using other people's IRAs to fund your own personal deals. That's how you make money today. Your retirement account is for money tomorrow, tax-free. Money today can be made through the use of other people's retirement accounts. So it's important to understand kind of the rules and who you can borrow money from. And this presentation is to help maybe give you some things to think about to help you as an investor attract more private capital. And at the end, we'll talk about different ways you can create win-win scenarios between yourself as the borrower and maybe an IRA lender who would be potentially a NewView client. So we're talking to not just NewView clients, we're talking to people who are third parties just looking to raise some private capital through retirement accounts. Important numbers to think about and why this is so important. As of Q1 2021, there sits about $35 trillion in US retirement accounts. That's 35 with a T, or trillion with a T. It's the largest source of Americans' wealth. More people have money in their retirement accounts than they do in their bank accounts. Everybody knows that. Why is that important to you as a real estate investor? That is probably the least tapped bucket of money sitting out there available to anybody that wants to tap into it, but it's never thought about. If you're buying real estate, you usually go to a bank and you get traditional financing. If you're trying to get financing quicker, you're going to a hard money lender. And those are all fine, but right smack dab in the middle is this big thing called private money. There's a lot of investors that have tapped into this and they have made their career off buying real estate without using any of their own money. They use other people's retirement accounts. So as we go through this, this will help you kind of unlock those doors. And even if you have been borrowing money from people's retirement accounts, I think the case studies will make you think, well, maybe there's different ways that I can structure deals to make it more of a win-win situation between me and my private capital individuals. So remember how much money is sitting in retirement accounts and why is NewView a piece of this equation? Because NuView Trust Company is a self-directed IRA custodian. We've been doing self-directed IRA administration since 2003. I'll explain why self-directed IRAs is important when you're talking about borrowing private capital, okay? But we are not a new kid on the block. We currently have 12,000 investor clients, all using their IRAs, 401ks, and other qualified plans to buy alternative investments. So our clients don't buy stocks, bonds, mutual funds, and CDs with their IRAs here. They buy real estate. They buy notes secured by real estate, or i.e. they're lenders, they're private lenders with their retirement accounts. That's actually what I do. Most of our clients are actually lenders with their retirement accounts, believe it or not. Most people who have retirement accounts like to be passive. But if an investor has an IRA and they want to do that type of investing, they can't do it at Fidelity. They can't do it at Charles Schwab. They have to do it at a company like NewView. So currently we have about $1.7 billion under management, and those are all alternative assets. The number that I want you guys to pay attention to, though, is this number, $150 million. What that number is that's the number of undirected cash. That's the amount of undirected cash that currently sits at NewView. That's made up of clients that have moved money over and they haven't found an investment yet. It might be a client who just sold an investment and now their IRA sits into cash. It's made up of a lot of different clients who have money sitting uninvested, and when it's uninvested, it makes goose egg. Now, as a self-directed IRA custodian, we can't sell them investments. So how do you tap into this $150 million? Well, I will tell you one way to not tap into it is you can't email me and I just tell you who the clients are. Unfortunately, that's not how it works. We'll talk about how you can tap into it when we talk about how you find private money, but $150 million just sits here in NewView in undirected cash available if you can meet the right client and provide them with the right opportunity. So where's all the moolah? Well, when we're talking about that $150 million in undirected cash, it sits in a variety of accounts that we administrate here at NewView. We have personal plans, which are IRAs that consist of traditional IRAs and Roth IRAs. That's probably 70% of the plans that we administrate here at NewView, and that's pretty much across the board when you talk about IRA custodians. But we also have employer plans for our clients who are self-employed, which can be made up of your solo 401ks, or some people like to call it a solo QRP. We have SEP IRAs, we have simple IRAs. A lot of clients right now who have these plans are rushing to make contributions prior to their employer plan deadline to make contributions. So a lot of people are putting money into these plans before October 15th, which is the tax filing deadline for most of them. Or if they have a 401k here at NewView, they're putting in contributions prior to December 31st. So at 150 million I mentioned, between now and the end of the year is going to grow higher simply from the contributions clients are making through their annual contributions. Now, that may not sound any different than what you're used to at Fidelity and Charles Schwab, because it's not. We have the same plans Fidelity and Charles Schwab have. Remember, the difference though is NewView allows clients to loan money out of their accounts, and their asset is a promissory note versus a stock. We'll get to that when we get to the case studies. But where's all that 150 million made up of? All these plans that I showed you, and we do have some clients that also lend out of their health savings accounts, or even partner their children's Coverdell education savings accounts in with the loans that they do. So we have 12,000 clients. It's made up of clients that have multiple accounts or one account, but that's where the money is. And remember, it goes outside of NewView too. There's a lot of companies that do what we do, but we're very experienced in what we do, and you always want to understand where to tap into the money. Right? When we talk about those accounts, understand what self-directed IRA means first, okay? Most clients understand what self-directed means. It's not a type of IRA. As you probably saw, the IRAs I showed you there are just IRAs. And IRAs are IRAs or IRAs. Self-direct is just a marketing term. Again, when I always remind people, an IRA here at NewView, basically our account agreement with our client says, invest in anything the IRS allows, but you find the investment. So when it comes to clients that use their IRAs to make loans, what they're really doing is they're finding somebody to make a loan to, okay? And we'll talk about how that could be done. Okay? NewView isn't providing that person. We're not putting people together. Self-directed means it's an entrepreneurial type of IRA, and you have to find those relationships. So if you're on the borrower side, there's two ways that you can go about this. One is try to have conversations with people that already have self-directed IRAs. That's usually the path of least resistance, right? Somebody already has a self-directed IRA at NewView. How do you get in touch with those people? How do you meet them? We'll talk about how you do that. But you should also, if you're a real estate investor, keep your radar open at all times about people that have retirement accounts. 65% of Americans have a retirement account of some type. Very few people understand what they have as far as an investment goes. So if you can be a resource to somebody that has a retirement account, and a resource being that you can take their money from their retirement account, secure it by real estate with a promissory note and a deed of trust, and pay them interest that exceeds what they're making in the stock market, well, then you might just make a client for life or make a lender for life. So again, there's clients that we have here that you want to meet with, but you also want to keep your radar out for people that may not have a self-directed IRA, and you may have to do a little education or at least get them our way so that we can teach them the powers of self-directed IRA before you start borrowing money out of their retirement accounts. Okay. Before we get into the case studies and how we'll look at different ways you can create win-win scenarios as the borrower, we got to talk about the rules with IRAs first. The main thing that you want to understand when you're talking about IRAs is IRAs are a separate entity. They're just managed by the IRA owner. So there are rules that the IRS sets forth that restricts someone from taking their IRA and doing investments with certain individuals. It really comes down to close family members, and these are all laid out in IRC 4975. If you're bored during the weekend, you want to read some tax code, go to IRC 4975. It's thrilling information. I'm gonna basically break it down for you so you don't have to read it though. But it is important to understand who you cannot borrow money from, whose IRAs you cannot borrow money from before you start going out there and looking for private capital. When you look at Internal Revenue Code 4975, they list things that are considered disqualified people. Okay, disqualified people are where prohibited transactions start. It always starts with the individuals involved in the transaction. A disqualified person is somebody that cannot benefit from the IRA's investment directly or indirectly and cannot do transactions with the IRA. Okay. If you draw in a real simple diagram here, there's you and then there's Mr. IRA. Okay. If I have an IRA, that means if I'm a real estate investor, I can't borrow money from my own IRA. That's self-dealing. I'm the fiduciary to my IRA. I have to find it investments with people that are not disqualified to me. If I want to take benefit from my IRA, I do so through a distribution, but I can't tell my IRA to make a loan to myself. Okay, that would be self-dealing. I can probably set up some pretty fancy deals dealing with myself, couldn't I? The IRS doesn't want that issue. They don't want self-dealing. They also have other people that are equally disqualified as the IRA owner. Okay, and if we just really simplify it, it includes the IRA owner, the IRA owner's spouse, their lineal ascendants, which would be parents and grandparents, lineal descendants, which are kids, grandkids, and their spouses, and any companies those same people own, control, manage, or are highly compensated by. Okay. So if I have an IRA and I want to make a loan, I can't make a loan to myself. I can't make a loan to my wife. Can't make a loan to my parents or grandparents, kids or grandkids, or any companies that's LLCs, partnerships, trusts, any entities I have set up that I have ownership of and receive benefit from. I cannot make a loan to my own company. It's just an extension of myself. Think outside the box. There's so many other people that you can borrow money from. You don't need to borrow money from family or your own IRAs. Okay, so I'm just want to make sure that you understand who you cannot borrow money from before you go out and start thinking, oh, I'll just borrow money from my mom's IRA. That unfortunately, that would be prohibited. Okay, and the things that those people cannot do would be they can't buy anything from the IRA, sell anything to the IRA, trade or loan, take a loan from or give a loan to the IRA or extend services. It's really pretty cut and dry, really pretty black and white when it comes down to it. So that's just the information I want to share with you guys. That's really all you got to do to stay out of hot water. And provided that you're going out and you're looking for private capital from people that are not on that list, you're totally fine. And here's what I always remind people when people say, well, I just want to use my mom's IRA, because she's got some money sitting there. Well, A, it's prohibited. And B, you're thinking too small. There's $35 trillion sitting in retirement accounts. Everywhere you go, there's somebody standing in the room, most likely that has a retirement account that is not one of those people on that list. If you're so focused on your own IRA and trying to figure out how you can borrow money from it, you're thinking too small. You got to think bigger and think to how you can build relationships with other people that are not family that may have IRAs that are not satisfied with their current investments. Okay? Think about people, if you open up the dialogue and you start talking to people, start asking them about what their financial situation is when it comes to retirement. Sure, there's some people that might puke out all their issues and, oh God, I'm invested in this thing and this stock and it keeps going down. And, I got all my money in AMC and, my wife's ready to divorce me because it hasn't shown any profit, yada, yada, yada. You'll find people that are not satisfied with their returns. If you can take that money out of the stock market and show them how they can get consistent returns secured by real estate by being a lender, there's a lot of positives that can happen in that situation. Okay, so we'll talk about that through the case studies and talk about how you can approach these people. But just remember the people you cannot borrow money from, but there's a lot more people out there that have IRAs sitting out there. So let's talk about money. Where do you get it? How do you have the conversations? And how do you set up win-win scenarios? So first, where do you find private money? Now, this is just a list I came up with. I'm sure that there's other suggestions. Do me a favor. If you guys are current private borrowers or lenders, maybe post in the chat where you find your private money without giving away your secrets. How I see it is I'm a part of a lot of real estate investor associations. So a lot of real estate investor associations will have investors that are self-employed, maybe they have a retirement account, and they like to use their IRA to lend to other real estate investors. That's one of the main sources that I would use. So in Central Florida, you want to check out CFRI, which is Central Florida real estate investors. You want to check out Go RIA. You want to check out the Jacksonville RIA. You want to check out the Tampa RIA, DRIA in Miami. Start attending your local real estate investor associations. Most of their meetings are free, but that's where you're going to find a lot of people that might have IRAs, but they also have an investor sense, which is always helpful. Going back to number one is just remember too, your network is equal to your net worth. So Real Estate Investor Association plays into that, but just your overall network is where you want to leverage people's retirement funds and give your resources as a real estate investor to help them make above average returns. Investor meetup groups. There's countless investor meetup groups, whether you go online or you go actual live. When we get back to more live things, there are tons of investor meetup groups through meetup.com, through Facebook. Start associating yourself with some of these meetups. This is where you're going to have access to funds most likely as on a large scale. But if you want to start narrowing it down, start looking to live events from self-directed IRA companies. Go right to the source. We're one in Florida. If you are in Central Florida or you want to come visit Florida, weather's pretty nice here. I'll just let you know. Okay, we have live events. Guess who attends our live events? Clients. It's probably 75% of our attendees at our events are NewView clients. I will give you a secret. 50% of those people are lenders. Why do they come to the events? A, because they like the education, they like to meet the staff, but they also are looking for investment opportunities. Their money sits there if they don't have somewhere to put it. So coming to the live events is something you definitely want to do, especially when it's put on by a self-directed IRA custodian. And at the end, we've got 2 live events coming up that I want to mention to you guys. So stay tuned for that. But if you're in another area, go to your local real estate, go to your local self-directed IRA providers events there. Most of them will have some live events or virtual events. This is considered an event too. So what I tell people oftentimes is if you're looking for private capital, there's nothing stopping you from coming in on these meetings and putting in the chat, or if you're watching on Facebook, putting in the comments, hey, I'm so-and-so, I've got some deals in Savannah, Georgia. If anybody's interested, please shoot me an email, something like that. For us, I'm okay with that because I'm not putting people together. I just don't expect me to pitch your deals for you. But as far as this is a public forum. This is a good way for you guys to communicate with one another. But then if you really just break it down, if you're looking for private capital, anywhere you see people is really where private capital is. If you are in any room, you look to your left, look to your right, there's probably someone in that room that has a retirement account, and they would probably love to at least hear about alternative investment options. And when it's real estate, people ears are always open for that. So the hardest thing is just getting the first one. I will tell you from experience, the hardest person to get to borrow money for one of your deals is the first one. If you can make that person money, pay them back, pay them on time, that's when it starts getting a lot easier. Okay, so we'll talk a little bit about the considerations here. Okay, before you borrow private money, understand that it's a relationship business. Okay, there's no website, there's no online forum that you can just go and then just get a list of private money lenders. Okay, if you're looking for IRA lenders, you have to go and actually find the individual in most cases. Now, there's some hedge funds that use IRAs to raise money and then they lend it out. That's different. I'm talking about actually going to an IRA, someone who has an IRA or a group of IRAs. You have to build a relationship. It's like dating. Okay, so make sure you get out to those RIAs, make sure you get out to the meetup groups and start having conversations with people that might be interested in your deals. One thing to keep in mind, if you walk up to somebody and say, hey, I've got some great investments, are you looking to invest any money? I've got some deals I can show you. Most people are not going to think about their IRA because they don't even know they can use their IRA. So again, you're always talking to 2 people when you're making relationships. You're talking to them, but you're also talking to their IRA too. You just got to unlock that piece of the conversation. Become knowledgeable about the process. Okay, it helps if you have your own self-directed IRA. Understanding the process means if you're going to talk to somebody about using their self-directed IRA or newly formed self-directed IRA to make a loan to you to buy real estate, it helps that you can understand the process or explain the process. What I mean by that, tell them, well, first you got to set up an account with NewView. Second, they've got to transfer money over from your Fidelity account to your NewView account. Third, we get a promissory note drafted. We have to send that over to NewView. They sign it. You give them a direction. You give them a direction of investment form, and then they fund the investment within 24 to 48 hours. You don't have to explain all the nuts and bolts. We'll walk them through the process. But if you can understand it from a basic level, then you're going to make it sound smooth and painless for them. If you're confused about the process, you go, well, you know, I heard about it. I don't really know how it works. Probably not going to have high success rate in somebody handing over their retirement money, some money that they've worked hard to save for, if you can't explain the process. And I will just be a little biased here. It probably helps to have your own self-directed IRA, go through an investment yourself. Then you'll understand the process and you could talk about it more eloquently to your potential lenders. 3, gauge the level of risk tolerance for each individual lender. What I mean by that is each person is going to have different wants and different needs. Okay. You can break it down and I'll give you an example. If you're talking to somebody that's got a retirement account that's sitting there, they're ready to invest, and they're in their mid to late 30s, that person is going to be more risk tolerant, right? They've got time to recoup an investment if it goes bad. Okay, so they're going to be more adverse to risk. They'll be willing to get into investments that might be a little bit on the more riskier side. But if you're talking to somebody that's past retirement age, they're not worried about home runs. They're not worried about big returns. They're worried about security. You got to be able to identify the difference in those two people and how you approach them. Okay, the conversations are much different when someone's 35 and when someone's 75, for example. You also have to keep in mind too, you're borrowing somebody's retirement account. It's the money that they've worked hard all their life to save. If you're talking to that person that's in their mid to late 70s, it's their only nest egg. They're not working anymore. They don't have income. If you lose their money, that is tragedy for them. If you lose the 35-year-old's money, it's not tragedy for them. They're not going to be happy with it, but you have to be a little extra careful when you're talking to someone who's past retirement age. If somebody has $100,000 in their retirement account and they're past their 70s, and you need $100,000 for your fix and flip, I'd be very, very cautious borrowing all $100,000. The chances of them needing that money back before your flip is done are greater than the guy who's 35 or the gal who's 35. You get what I'm saying? So you want to make sure that you leave your potential lenders in a position to where they're not losing sleep at night. So each individual is going to have different risk tolerances. And this is where the relationship comes in. You want to gauge, you want to ask questions. What is it that you need? Are you looking for more security? Are you looking for more of a return? Are you looking for an equity piece in the deal? And then at the same time, you need to be conscious of what their needs are that they might not be telling you. And that would come to when somebody might need money that you can't give them back. So remember, always keep your always keep the risk tolerance in mind. And always, and I know this is hard to do sometimes, if you use somebody's money out of their retirement account and the deal goes bad, make them whole, even if it means you lose money on the deal. I'll give you a quick example. I had a gentleman friend, he was an investor. He borrowed private money from people's retirement accounts for decades. Okay, he did fix and flips. He did all sorts of investments. Okay, everything went pretty fine in the most cases, except this one case where he borrowed money from somebody's IRA, and it was just the deal from hell. You guys know what I'm talking about, right? The foundation had some issues. The roof collapsed. There was 2 floods that year. Everything that could have gone wrong went wrong with this property. It just happens, right? Nobody's adverse to you're going to stub your toe every once in a while. But here's the moral of the story is that he had to sell this investment at a loss. Okay, he had to raise more money to get the deal finished. It really took a toll on him, and it came down to a point to where he had to sell it, and he wasn't going to make back what he had put into the deal. But remember, it wasn't his money, it was somebody's IRA. It was to the tune of $37,000, which is where the loss was. And he had a decision to make. The decision he had to make is he could have said, well, I'm sorry, this deal went bad. You're probably never going to want to do a deal with me, obviously, again, but we're going to have to sell this property at a loss. And he could have left the lender with the loss. But he decided to go the high route. And he said, you know what, I apologize. Everything went wrong with this deal, but I'm going to make sure you're whole and at least get your principal back. So what that meant is he reached into his pocket and he made the investor whole. Now, at this point, he thought his career was done. Right? He started looking for another job. He figured, you know what, I'm going to get out of this game. Nobody's going to want to loan me money after they hear about what happened with this deal. Can you guys guess what happened? The complete opposite happened. He said after that got around the Real Estate Investor Association group that he was associated with, he started getting 3 times the calls he did before. He started getting calls from people saying, hey, I heard about what happened on that deal with Bob's IRA. That's really unfortunate, but I heard you made him whole. Hey, let me know when your next deal comes up. And I'd be interested in being your private capital partner on there. So you got to think about that. If you take the low route, I would be willing to bet the real estate community will find out and you probably won't get any more private money. But if you keep your lender's interest at all costs, even if it means you lose money, you'll continue to be in business and you'll continue to be able to raise private money. Okay. So let's talk about win-win scenarios, and I'll kind of actually break down each one of these. I don't have an example of convertible note, but I'll talk about what it is. But when you're talking about raising private capital, understand that you have different options, how you can use somebody's retirement funds and implement them into your real estate investment or just investment in general. Most people just use what's called a simple interest loan. Okay. We'll talk about that. Some people go outside the box, okay, and do things like joint ventures. Okay, you can use an IRA as their private capital partner, okay, in a joint venture, and there's pros and cons to each of these. So I'll talk about the differences, and you can kind of decide for yourself when you use which tool. Think about these like tools in your tool belt. Okay, you want to give a menu of options to your clients, and sometimes there might be one that fits a better situation than others. But have more than just one option. Don't just go into every deal and say, I pay 12% or I pay 10% and it's simple interest loan. Have a little bit of flexibility because you might even find that you can do deals that you couldn't do before because the terms of the loan maybe weren't advantageous. We'll talk about convertible note. Convertible notes, you usually see these with loans to companies, okay? But it is a way that you can use private capital from somebody's IRA. But we're not going to talk about that here. We're going to stick to kind of the real estate options, which would be simple interest and joint venture. But we also see kind of a matrix, which is called the shared appreciation loan. And I've done these before as well. So let's talk about the pros and cons, but let's just go through a quick scenario first. If you haven't seen this before, I'm just going to go through a real basic case study, okay, and how somebody used money from somebody's IRA, okay, as the lender in the deal. So Alex Smith had $100,000 in an IRA, wanted to make a loan to an investor friend, not a disqualified person, and that loan would be a first lien mortgage to buy and fix up a property that had an after repaired value of $140,000. So why is that important? Obviously, if you're the lender, you want a little bit of equity or skin in the game. And $100,000, I believe it was $70,000 to buy the property and $30,000 to rehab it. So this was an investor friend that he found at a networking group. And what they do from this point on, once the investor says, here's the investment that I have, if you're interested, what do they do at that point? They come to an agreement on terms. NewView does not decide the terms on your promissory notes, and this would be a simple interest note. What you would do is you would get an attorney or you get some professional to draft you the promissory note. Okay, that's not something NewView does. That's something that you would have to do either as the borrower, or if you're the lender, you can use a lender's attorney to draft your note as well. But somebody needs to draft the note. The note needs to be specific with the terms. And again, we don't dictate what terms need to be in there. All we ask for as an IRA custodian is that there's a clear method of profit, meaning what's the interest payment, when are the payments due? And we also need a maturity date. When's the loan expire? Okay. So we need the lifetime of the loan and what's going to be charged. All this other stuff is just whatever you agree upon between the two parties. So in this circumstance, what they agreed upon is that the borrower would pay the IRA 10% interest. Those would be interest-only payments with a balloon payment in 1 year. So most of the time, most clients, they don't want to be invested in loans longer than a year or 2 or 3. I'll just give you that as just a tip. Most clients, including myself, I like to do 1-year notes because I like to get my interest back and then reinvest the interest so I can compound my interest. But most people are not going to keep a loan. A borrower is not going to keep a loan at 10% forever. They're going to refinance after a year. And that's perfectly fine with me and most IRA lenders. So in this case, the 1-year note with the balloon payment just means the loan spread out as if it was paid over 30, but it's really all due in year 1. They put a minimum loan term of 3 months in the deal. Why? Well, if you're going to go through all the work and do all the paperwork, do you want to have the money paid back the next day? Sometimes that's the worst case scenario is you get, as a lender, you get paid and you get paid back early. But so they did a minimum loan term of 3 months. They added a 2% origination fee, which is just upfront interest. And the buyer or the borrower in this case said, I'll pay all your NewView fees and legal fees. Now, why would the borrower pay their NewView fees? Well, think about it this way. If you're the borrower, you go to Bank of America. Do they have fees? Yeah. If you go to a hard money lender, do they have fees? Yes. NewView clients also have fees, but I will tell you they are a fraction of the price that a conventional bank charges and a way more fraction of a price than a hard money lender charges. I will tell you a transaction cost on that on the NewView side would be $95 to process the transaction and at most $295 as an administration fee for the year. So you're talking less than $300. Well, you can add a wire fee on there too. So you're talking about $400 in total fees. Is that the cost of doing business to use somebody's IRA? I would say, heck yes. So if you're a borrower, part of the process and make it smooth and painless on someone is say, hey, I'll pay your NewView fees. You don't got to worry about that. That helps me as the lender too, because I just know I get 10% interest and 2% origination fee. I don't have to find what my blended rate is minus the costs and things that I have to pay. So if you're looking to unlock more private capital, think about ways to make it smooth and painless on your private lenders. So one way is paying their NewView and legal fees. So does this work out? Is this a win-win scenario? I would say yes. The IRA owner, Alex Smith, made 12% in 1 year. 12% is great return. Think about if you made 12% year after year after year, there wouldn't be people complaining about not having enough for retirement if they made 12% annually on their investment. And this investment was secured by real estate. They closed it a title company. They did all the things. So the only difference is that promissory note that usually says Bank of America, promissory note said NuView Trust Company for the benefit of Alex Smith's IRA. That's the only thing that was different. Now, did this work well for the borrower? Some people will say, well, why would he pay 12%? That sounds like a lot, Nate. Is it? Think about this. How much money did he put into it? Zero. Okay. How much money did he make on this deal? Well, based on the numbers, somewhere around probably $30,000. If you had a situation where you put zero in and got $30,000 out, how many deals would you do? All of them, every single one you can find like that. Could you get a better rate at a bank? Sure you can. But what's a traditional bank going to ask you for if it's investment property? They're going to ask for 30% down. They're going to run your credit. They're going to ask for your tax returns. They're going to ask for your 10-year residency, no gaps. They're going to ask for your blood sample, your firstborn. And then maybe in 45 days, they'll give you the money after the underwriter looks at it. Okay. This was done in 4 days. Okay. Why? Because all we need at NewView is just a copy of the note and the client to fill out the note purchase packet, and we can get the money out just like that. And this is a cash offer. Now you've got a cash offer that you can make. And when inventory is low, how do you pick up more property? Come in as a stronger buyer, and being a cash offer is going to be a stronger buyer. Other things to think about. If you go hard money, could he have gotten hard money? Yeah, but hard money is going to be upwards of the 18%, because they're going to charge the maximum that the state limit allows when it comes to usury rates. So when you're talking private money, there is a definite need for private money. You want to understand it. And people always say, well, what's the average rates for private money? It's between conventional, it's between hard money. It's pretty simple. So anywhere between 7 and I would say 12% are your typical rates. But it really comes down to, again, the individual. Not every investor is going to need 12%. You're talking to somebody who's a little bit higher in age and they're not looking for home runs. They're just looking for safety and security. They might be satisfied with 5% returns, but that's going to come through your negotiations with them and finding out what their needs are. Okay. I'm going to skip past this for a second. Key points to remember. Remember, you can't loan money to yourself or any other disqualified person. You and the borrower are free to set your own loan terms, and IRAs can loan money unsecured or secured by other assets other than real estate, such as equipment or mobile homes. But obviously, the most common scenarios when we see loans secured by real estate. So what are the pros and cons of simple interest loans? And then we'll talk about joint ventures, and then we'll talk about shared appreciation. Pros to simple interest loans. Like the title says, it's simple, okay? You as the borrower still get all the benefits of depreciation. So that's one of the benefits of buying real estate is you get depreciation. It gets to offset your taxation as an individual, okay? You don't have to give up any of that because you're just borrowing money from a person who's going to be a lender. You are in control. Okay, you're in control. You make the decisions. The lender has no decision, just like any lender would have no decisions as to when you sell the property, what types of appliances you put in the house. You're in control. You're just using money through someone's IRA as a lender, and you could potentially make more money on the deal because all the equity goes to you, the investor. What are the cons? The cons to a simple interest loan is that based on your terms of your agreement in the promissory note is that payments are going to be due whether or not you make money. Okay, so be cautious of that because you want to make sure that you have the ability to make the payments to the lender, because if you don't make the payments, then obviously you might be in a situation where they might foreclose on you. Okay, so there is a debt instrument, there is a lien against the property. It's no different than taking a loan out from a bank. Okay, so you do have the, there could be the issue where you lose the property through foreclosure if you don't satisfy the terms of that agreement. So you also you can be creative with this too. If you're a real estate investor that's doing a flip, you can ask the lender to negotiate maybe that you have a couple months of no interest payments because you're not making any money on the deal until you get the property rehabbed and fixed up and sold. But those are all things that you can negotiate with the client. I always tell people though, as a lender, I'm always going to charge interest at some point because it's my only way to gauge whether or not the loan is performing or not. So the cool thing about these simple interest loans when it talks about private money is you can get really creative with the terms when it comes to payments, how the payments are made, and yada, yada, yada. So interest loans are the ones that we see most often. Here's one that I did, and this is just to kind of point out to the fact that you don't have to just look for somebody that has one IRA. Partnering IRAs is something that happens very, very often. Okay, you probably don't see it. We see it all the time because we process the investments, but a lot of our investments are considered what we call split assets. Split assets are just an asset that's split ownership amongst different IRAs. And sometimes people are forced to do that because they don't have enough money in say one IRA to do a loan. But if they partner their IRA with their wife's IRA, their brother's IRA, and maybe they have a health savings account, when they use all those accounts together, then they have enough money to do a deal. So this is a deal that I did. The borrower approached me, and this was at a real estate event. I had known him. I had built a relationship with him. I knew his track record. And we had not done a deal before, but he came up to me and he said, "Hey, Nate, I got this deal. I've already tried to go to the banks for this. Banks wouldn't loan money on it because it was not in good condition. So most traditional banks are not going to take a risk of loaning on money on a property that's been abandoned for 2 years. And that was the situation with this one. He only needed $55,000 though, $55,000, but the ARV he told me was $125,000. So immediately when the borrower approached me on this, I thought, well, that sounds pretty safe to me. Can you give me 24 hours and let me run some comps and take a look at this property and see if it's something that we want to do. So what I did is I ran comps, and I actually had a friend run the comps for me. And he came back and said, "Nate, I think he's being conservative. I think it's around 137, to be honest." So it piqued my interest even more. Within 24 hours, what I did at that point is I went to different people who I knew had IRAs, and I just asked them simply, "Do you have some cash that's sitting uninvested?" Well, long story short, by the end of the day, I had 8 IRAs, which were made up of 4 people, right? Each person had usually 2 IRAs in that situation. And we had 8 IRAs that all partnered with just some chump change that we had in our IRAs, all on one promissory note. Now, that doesn't make it the transaction any more difficult. It's still one note. Each IRA, all 8 IRAs are listed on there as a fractional interest owner of the note. There's still one lien position. And because the deal had to be done so fast, the borrower was willing to pay 2 points and 12% for a 1-year loan. Again, this is a loan that we did with the intention that he was going to refinance after a year, perfectly fine with everybody involved. And the borrower, again, in this case, paid all the NewView fees, okay, which was, fees for each one of those accounts. We closed in 4 days and everybody was happy. Everybody that partnered on the deal was happy and he was happy, and he still kept that property as a rental after he refinanced us out. And we did more deals with him in the future. So that's just another example of a simple interest loan, but partnering IRAs together. And as a borrower, you want to make sure you understand that concept. Let's talk about shared appreciation. So shared appreciation is a combination of a simple interest loan, but you can have a clause in that promissory note that gives your lender a piece of the equity. Now, some people say, why the heck would I give up my equity to my borrower? Hold that thought, because there's certain deals that it might make a lot more sense to do that. And in this specific case that I'll show you, they had to do it this way or else they wouldn't have got the deal done. So what is a shared appreciation loan, or what are the pros to a shared appreciation loan? Well, one, if you're the borrower, it gives your lender more options to participate. So again, you're probably not going to find somebody, late in retirement that wants to do something creative like a shared appreciation loan. But you talk to somebody who's a little bit younger that wants to maybe learn about investing and wants to have a piece of the deal. Well, this might be a good option for them to participate. So it gives you, as the borrower, just more items on your menu for your potential lenders. You can negotiate sometimes better terms in regards to the interest payments. So think about the deals where, well, I don't know if I can cash flow on this investment at that interest rate. So maybe if I give a little of the equity at the end, I can negotiate a lower interest rate in the interim. Okay, so it can be used as a negotiation factor to reduce payments or fees up front, i.e. points and things like that. You still get all the benefits of depreciation. So just because the lender in the promissory note has a piece of the equity, that doesn't mean that they steal out on the depreciation of the asset. And you're still in control because they're still a lender in that situation. Okay, just because they have an equity piece does not make them in control. You still have all the control, which again, that might be something that you want. You don't want your shared appreciation lender is not going to be telling you what types of cabinets to put in the house. Okay, if that makes sense. What are the cons to a shared appreciation loan? Well, again, payments due no matter what. So you're in that same lender borrower situation. You've got debt on the property with a lien against the property. And you can potentially make less money on the deal. And I say potentially because there's some times where you might not even get a deal done unless you do it this way. And let me show you an example of that. Okay, so this is a situation where the investor, the borrower, had a property that was a double wide mobile home, okay, outside of Fort Worth. Okay, sounds like a fantastic investment, doesn't it? Well, it wasn't the mobile home that was so attractive of this investment. It was the land that it sat on. It sat on over an acre of land. It was out in an area that you could kind of tell property or population was growing, and the investor felt really confident that that area of where the land sat was going to be really, really in high demand in 5 years. So this was a buy and hold for appreciation of the land, not the mobile home. So, so he was out there looking for private capital. Now, if you have ever tried to go to a bank and borrow money for a mobile home, you will understand pretty quickly that banks don't like mobile homes. Okay, they don't like to finance mobile homes. Could you go to a hard money lender? Sure, you could, but do you want to pay 18% while you're trying to hold a property for appreciation? Okay, and this is a property that wasn't easy to rent. Where it was located, it wasn't highly populated. You can get people to go out there, to do some fishing. There was a pond and things like that, but the rental market was not saturated with a lot of renters. So the investor was just a little bit cautious as to how much he can collect in rents, because it wasn't something he can rent throughout the year on a consistent basis. But he was confident that he can rent it out during the springs and the summers and things like that. So these individuals had done deals in the past, and it was always a lender borrower situation. Okay, it was usually 12 points charged, or 12% charged by the lender, maybe 2 points up front. And the borrower was perfectly fine with that. That worked on all the deals prior to this one. Well, when he was looking at this deal and he was running the numbers, and based on the rents that he can pull in, he was looking at a big red figure, meaning he was going to have to pay out of his pocket, the borrower, to pay the difference in what the rents were going to cost compared to the mortgage payment he was going to have to pay to the IRA. And he was looking at that over 5 years and said, that's just a lot of money that I'm going to have to fork out in 5 years. So they walked away from the deal, or the investor walked away from the deal. But then they stopped and they reconsidered. Okay, they reconvened. They said, well, the lender in this case, the IRA owner, said, well, I like the deal. I mean, I like the area. I've been out there. I understand it. I would be opposed to. I would be open to doing something, a little bit more creative. What if we did this? What if we did a loan with a shared appreciation component? Okay, instead of 12%, I'll charge you 6%. And let me tell you how they got to this interest rate. By the way, the borrower went back and said, this is what I think I can collect in rents. And then they just factored that in and said, what would that equate as far as a mortgage payment goes? So they backed into the 6% interest. It wasn't just thrown out, out of their back pocket. The borrower said, I can pay this amount and that should break me even while I hold this property. So that's how they came up with the interest rate. Because now the lender is going to be a piece of a longer term play, okay, they decide there's no reason to charge an origination point. So from 2 points up front to 12%, now they're at 0 points up front to 6%. But the trade-off is, as the part of the note agreement, the lender would get 50% of the equity at time of sale. This doesn't put the lender in any controlling position, but it does put them in a position to where they have a stake in the game. So here's what happened with this deal. Fast forward in time, they held this property 7 years. Okay. In the 7 years, all of the rents were able to cover the loan payments. The borrower didn't have to come out of pocket at all over the 7 years while they held this property. The property appreciated in value from $50,000 to $130,000. They sold the property and they actually even kept it longer than 5 years because they thought, well, it's still going up in value. Let's keep it a little bit longer. So the initial plan was 5, they sold it at 7. And as part of the agreement, they split the $80,000 in profit 50-50. So let's look at this from the IRA's perspective as the lender. How'd the IRA do? The IRA put in $50,000, and this was a Roth IRA, by the way, put in $50,000, got 6% interest over 7 years, which is not better than a poke in the eye with a stick, and got $40,000 7 years later in equity when they sold. I think the Roth IRA did pretty darn good. How did the borrower do in this situation? He came into the investment with no money. Okay, and walked away with $40,000 in 7 years. Okay, did he give up a piece of his equity to do it? Yes, but he didn't have a deal before that. So you could see how being flexible and being creative with your terms can create a win-win scenario in this case. And remember, as the borrower, there's no credit that was pulled in this situation. It doesn't go against him going out and getting Fannie Mae loans or Freddie Mac. So he has the ability to use somebody else's money without putting any skin in the game for himself and walk away with $40,000 in 7 years. So that is a shared appreciation loan. The last one I want to go over is just joint ventures. Now, joint ventures is different because it's not a lender-borrower position. It is a partnership. Okay, it's very different. There's some pros and cons to it as well. The pros to a joint venture is as you, the borrower, or the, sweat equity partner, I'll say in this case, it gives your private capital partner more ways to participate, just like the joint venture. There's no lien and there's no loan payments due because it's not a loan. Okay. Joint ventures are an agreement that you establish that's specific to an investment that lays out what each party does. And when you're talking about an IRA, the IRA is always going to be the capital partner. And if you're the borrower, you're the sweat equity piece, you're the sweat equity partner. How you dictate how the profits are split are up to you and the IRA owner. Okay. Oftentimes I see it split right down the middle. The sweat equity partner is going to do all the work. The IRA partner is going to put up all the capital, and then they split the profit 50-50 down the middle. Okay. So joint ventures are partnerships, and partnerships split profits based on the details of the agreement. If there's no profit, there's no payment. So again, you're not locked into a certain payment. If there's no money coming in on the deal, and it's part of the joint venture agreement, then you don't have to worry about being foreclosed on for missing a payment. So I often see beginning investors use it. There's some cautions there, but it is an easy way to get into an investment without being at risk of foreclosure on your first deal. Just food for thought. Cons, you have a partner to contend with. So this is not a lender position where you're the borrower and you have full control. you lose some of the control because you have a partner to contend with, right? You've got to come to decisions mutually on things. So do you want to be in a joint venture with every person that you meet at a RIA? Probably not, but you want to being involved with deals where you know that the person's going to be around for a while and you see eye to eye and you're fine with being a partner with them. And you do lose a part of the depreciation in this case, because now you're losing out on some of the ownership rights because someone else is going to be an owner with you. What's a good example of a joint venture? So here's a great example of a joint venture. So an investor actually bought a piece of land, which was a small piece of land that he had bought for $12,000. Okay. Sorry, she bought for $12,000. Now she bought this land because it was just a good deal. And it was really all that she could qualify for. And she didn't have enough money. She was a beginning investor. She didn't have enough money to do anything with it, but it was a good piece of land and it was in a good area. So she went to her local RIA, she met some investors, she kind of held this piece of land, for a little while, but she always wanted to build something on it. She didn't necessarily have the credit to go get financing, to get a loan, a construction loan or anything like that. But she started making some relationships and she networked with somebody that had a traditional IRA that had just moved it over to NewView and wanted to self-direct it. So what they did is they agreed, since there really is no structure to secure a loan to, I mean, she can take a loan and secure it by the land, but it's $80,000 is what the loan was going to be for. So they decided to just do this as a joint venture to where she, the investor, owned it personally. She'd be the sweat equity piece, and the IRA owner would use their traditional IRA and $80,000 of it to front all the construction costs. Okay, so in this case, it's a partnership. There's no interest payments due. There's no origination fees charged. The JV agreement said that the partners would split all the profits after construction was done and they sold the property. They would split it 50-50. They held the property for 13 months. Why 13 months? To eliminate short-term capital gains. So again, they held the property for 12 months or longer than 12 months, and they sold it at month 13 for $149,900. Giving the JV partners a split approximately $40,000 in profit. Actually, there's a lot more than that. I apologize. I did that. Well, it's about $40,000 after fees. So they split $40,000 in profit in 13 months. How'd the investor do? Well, she invested $12,000 and got $20,000 a year later and didn't have to inject any more money and get a loan that ties up her credit in the meantime. How did the IRA do? I think pretty darn good. Put in $80,000 and got $20,000 in profit in just over a year. Okay, that would be an example of a joint venture. One thing that I will mention though, as a cautionary thing, if you are the capital partner in a joint venture, realize that oftentimes the way it's structured, you could have less security in the deal, okay, because it's not a lender borrower situation. So does it work well in every situation? No, but does it work well in some situations like this? Yes. Another thing that I want to mention too is IRAs could joint venture with other IRAs. I know a circumstance off the top of my head where a gentleman owned a piece of land in his IRA and used a joint venture to borrow money, not borrow, but use joint venture to get capital from another IRA to do the same thing. Now, the reason they did a joint venture in that case, if you watch some of my past presentations where we talk about UBIT or UDFI, unrelated debt finance income tax, remember when an IRA borrows money, it's subject to taxes because it's a debt leveraged investment. When you joint venture, there's no debt, so there's no UDFI. Wink, wink. So if you want to get around the whole UDFI thing and you've got an investment owned in your IRA, well, maybe think about doing a joint venture instead of a loan to your IRA if you find somebody that's got some money that want to inject in your deal. So just a little bonus information there. So I hope this was beneficial to you guys. I want to see if there's any questions. Grace, we got any questions? No questions? Hot diggity. Well, if you guys have questions, what I want you guys to do is email me at IRAspecialists@NuViewTrust.com. Email me for two reasons. Either if you have questions, we can get those answered for you guys. Again, that's IRAspecialists@NewViewTrust.com. I also want to encourage you guys to talk to my IRA specialist if you want to establish your own self-directed IRA, or if you are a real estate investor and you have people that you might want to unlock their retirement funds. They're going to need self-directed IRA. So make sure that you email us, and we're doing a special promo this month where we're not only waiving the application fee of $50, but we're giving people $50 account credit towards future fees. this is a great deal if you are a borrower, because this will help you, because you're probably the one going to be paying those fees. So now is the time to get these accounts set up. If you've got some people in your network that need to set up IRAs to do some self-directed private lending, reach out to us this month. Again, IRA specialist at NuViewTrust.com. And if you're looking to network and tap into some of the people that might have funds in an IRA, I'm going to give you 2 events that you need to come to. Okay. Our class tomorrow, if you are in the area, we're going to do a live class here at our NewView offices. The address is right there, 280 South Ronald Reagan Boulevard, Longwood, Florida. It's going to start at 6:30. 6:30 sharp is when networking starts. Okay, sorry, 6. Grace is correcting me. 6 o'clock is when networking starts. 6:30 is when the presentation starts. Grace will be extremely disappointed if you don't show up or if you show up late. Okay, so remember, you don't want Grace on your bad side. Trust me. So 6 o'clock, show up. Okay, that's when networking starts. We'll have food. We'll have beverages. We're going to have a good time. And if you're an investor that has deals that you want to pitch, I'll let you get up on stage with me and pitch your deals. Remember, I'm not promoting your deals, but I'll let you get up in front of the room and pitch your deal. So bring a friend, bring a family member if you want to learn about how to use self-directed IRAs yourself and network with clients that might have self-directed IRAs to use for some of your deals. Make sure to come to that class. That is tomorrow, September 16th. Also in October, we're having our next quarterly event. If you were at our last quarterly event at the Orlando Science Center, you know how good that event was. We had about 100 people. We're expecting even more this time. We have the venue booked for 200 people. It's going to be a different venue. It's called the Venue on the Lake. This is in Maitland. And I have a special announcement. We have a special guest speaker, okay? Rod Khalif, the multifamily master himself, Florida native, is going to be our special guest speaker for the Night with NewView event. That is October 27th. Space is limited. Make sure you go to our website, make sure you register, because we're not going to be able to fit all the people that probably want to come. But Rod Khalif has announced that he's going to be our speaker. Normally he charges to speak at events. He's coming to speak at NewView for free, and we highly appreciate that. And he's going to be a great resource for you guys, and it's going to be a great night. We'll have food, we'll have beverages, we'll have a great time, and that's going to be October 27th, 6:30 to 9:30 in Maitland at the Venue on the Lake. Make sure you register on our website. So come to the class tomorrow, come to the quarterly event on the 27th, and make sure that you email us at IRA specialist at NewViewTrust.com if you want to take part of that 50/50 promo that we got going on. Grace, did I forget anything? Alex, did I forget anything? All right, guys, I hope this was beneficial. I hope you learned something from it, and I hope I hear from you guys soon. So take care. Have a good rest of your Wednesday.